Hey everybody, Larry Luna here with Team Luna Homes, powered by Cross Country Mortgage and brokered by eXp Realty. And today we're going to talk about the elephant in the room. We're going to talk interest rates and what exactly affects interest rates. Well, interest rates are basically based off of a bunch of different items, inflation, the employment, the economy. But for the most part, the long-term investing of mortgage-backed securities is the bond market. And as that fluctuates, so do interest rates for mortgage loans. So today we're going to talk about some things that you really need to focus on, because it's the things that you can actually control that will help you get the better interest rate. Things that you can't control, such as the market, there's nothing that you can really do about that. So today we're going to focus on the things that you can control and that you can physically do something to help you get the better interest rate. And keep in mind, the interest rate is a temporary thing. The house is permanent. The interest rate can change at any point in time, and you can refinance at any point in time to change that payment. So don't marry yourself to that interest rate. Just date it. You want to make sure you're marrying and permanently staying with the home that you're living in. So let's talk about some things that you can control. So that being said, there are mainly three items or factors that you can control when it comes to the interest rate, but we're going to talk about 5 altogether, because these are the items that you physically actually have control over. Number 1 is your credit score. If you need help in determining the minimum credit score that you need, remember, keeping in mind, the better the interest rate, the higher the credit score. The lower the credit score, the higher the interest rate. So you can directly affect the type of interest rate that you have based off your credit score. Number 2 is the loan type. What type of loan? Is it a government loan? Is it a non-qualified mortgage loan? Is it a standard conforming loan? Different loans have different rate pricings. What's the term? Obviously, terms on a mortgage loan can be anywhere from 30, 25, 20 to 15 years. And depending on the term that you choose, that will affect your interest rate. The down payment, which determines basically how much you're actually financing. The more you put down, the less you're financing. The least you put down, the more you're financing. That is a big determinant. And then last but not least is the rate type. Is it a fix? Is it an ARM? Those different types of things combined together are things that you can actually decide and control to help decide what's the best interest rate for you. Now, navigating through that really takes a lender who's experienced and knows how to, number 1, work through your credit report to get the most out of your credit score. Remember, there are 3 credit bureaus that are used. The mid score is what's actually used in qualifying for a mortgage. If there's something that would bring you into the next tier, that would save you maybe a quarter point on your interest rate, there are tools and resources that a good lender can utilize to help guide you to taking care of some items that could help bring you into the next credit tier. So those are really some important things that you need to sit down with your lender. And if you'd like to know more about your situation and your financial and credit position, please feel free to use the link below. Schedule your no obligation one-on-one phone consultation, and we can get some answers directly to you about what it would take to get you the best interest rate and you into your home. Hope this information was helpful. If you have any questions, please feel free to reach out. Otherwise, thanks for watching, and we'll see you soon. Bye-bye.